Welcome to the channel, everyone. Today we're talking about investing, and no, you don't need a Wall Street suit for this. We're breaking down how to invest smart based on three simple things: your age, your risk tolerance, and your time frame. Think about it like this. Your investment strategy in your 20s is going to look a lot different than your strategy in your 50s, right? You've got more time to recover from losses when you're younger, so you can afford to take on more risk, potentially for bigger returns. Alright, let's talk about those early years, your 20s and 30s. This is a period of your life filled with opportunities and potential. It's a time when you can lay the foundation for your financial future. You're fresh out of school, maybe starting your career, or maybe you're even a few years in. You might be navigating your first job, learning the ropes, and figuring out what you want to do long term. The point is, you've got something really valuable on your side: time. Time to grow, time to learn, and most importantly, time to invest. This is the time to be aggressive, to go for those high-growth investments, even if they come with a little more risk. The beauty of being young is that you have the luxury to take these risks. Think about it, if you invest $10,000 and you lose half of it in a market crash, that hurts. But it's not the end of the world. But you've got decades to make that money back and then some. The market has historically always bounced back, and with time on your side you can recover and grow your investments. You have the time to ride out those market dips, those corrections, even those recessions. The market is like a roller coaster with its ups and downs, but over the long term, it trends upwards. In fact, those dips can actually be your best friend because you can buy more when the market is down and watch it grow exponentially over the long term. It's like buying stocks on sale. So what are some good investments for this stage of life? You have a variety of options to consider. Well, index funds are a great place to start. They offer a simple and effective way to invest in the stock market without needing to pick individual stocks. They're low cost, diversified, and they give you exposure to the broader stock market. This means you're spreading your risk across many companies. You're essentially buying a tiny piece of hundreds of different companies. This diversification helps protect your investment from the volatility of individual stocks. It's like a one-stop shop for building wealth over time. Consistent investing in index funds can lead to significant growth over the years. Another option is to look into individual stocks. This can be more exciting and potentially more rewarding. Now, this is where it gets a little riskier, but it can also be more rewarding if you do your research. Picking the right stocks can lead to substantial gains. Just remember to diversify. Don't put all your eggs in one basket, especially when it comes to individual stocks. Spread your investments to manage risk. And hey, if you're feeling really adventurous, you can even dip your toes into real estate. Real estate can be a great way to diversify your portfolio and build wealth. The key takeaway here is this: don't be afraid to take on some risk in your 20s and 30s. This is the time to be bold and make the most of the opportunities available to you. Okay, now let's fast forward a bit. You're in your 40s, maybe you've got a family, a mortgage. You're starting to think about those future expenses like your kids' college funds, or even your own retirement. This is the time to start finding a balance between growth and risk. You're not as young as you used to be, right? Your time horizon is shrinking, but you've still got a good 20, maybe even 30 years before retirement. So, you don't want to get too conservative just yet. You still want to keep growing your money, but you also want to protect what you've worked so hard to build. This is where a more balanced portfolio comes into play. You might want to start shifting some of your investments from those higher risk, high growth options into something a little more stable. Now, I'm not saying ditch the index funds or the real estate altogether, but you might want to consider adding some bonds to the mix. Bonds are like the chill older brother of stocks. They tend to be less volatile, which means they don't fluctuate in value as dramatically as stocks. They offer a lower return than stocks, but they provide that stability and income that can be really valuable, especially as you get closer to retirement. The bottom line is this: your 40s are all about finding that sweet spot between growth and stability. Chapter 3. Investments for those in their 50s. Prioritizing stability and growth. Alright, let's talk about your 50s. This is a pivotal decade in your financial journey. You're likely at the peak of your earning years, the kids might be getting ready to fly the coop, and retirement is no longer some distant concept. It's right around the corner. This is the time when many start to feel the weight of their financial decisions more acutely. This is the time to really start prioritizing stability and making sure you're on track for retirement. It's about balancing your current lifestyle with your future needs. Now, I know what you're thinking. Graham, isn't it a little late to start thinking about retirement in my 50s? The reality is, many people find themselves in this exact situation. And the answer is, it's never too late, but the sooner, the better. The key is to take actionable steps now to secure your financial future. The good news is, you still have time to make a big impact on your retirement savings, even if you're starting a little later than you'd like. With the right strategies, you can still build a comfortable nest egg. At this stage, you want to make sure your portfolio is aligned with your risk tolerance and your time horizon. This means reassessing your investments and making adjustments as needed. You're probably less comfortable with big swings in the market, and that's totally understandable. Market volatility can be nerve-wracking, especially as you get closer to retirement. So, you might want to consider shifting even more of your portfolio into those lower-risk investments like bonds. Bonds can provide a steady income stream and are generally less volatile than stocks. But hold on, don't get too conservative just yet. It's important to strike a balance. You still want some growth in your portfolio, especially since you're likely going to live for another 20, 30, maybe even 40 years after you retire. This means keeping a portion of your investments in growth-oriented assets. Inflation is a real thing, and you want to make sure your money is keeping up with the rising cost of living. This is why a diversified portfolio that includes both growth and income-generating investments is crucial. Chapter 4. Investments for people in their 60s and beyond. Protecting your nest egg. Alright, you made it. You're in your 60s, maybe even older, and retirement is finally here. This is a significant milestone, a time to celebrate all your hard work and dedication over the years. You've worked hard your entire life, and now it's time to enjoy the fruits of your labor. Whether it's gardening, fishing, or hitting the golf course, these are the moments you've been waiting for. But even in retirement, it's important to make sure your money is still working for you. This means staying on top of your financial situation and making informed decisions. At this stage, your focus should be on preserving your capital and generating income. It's about finding that balance between enjoying your retirement and ensuring your financial security. You want to make sure your money lasts as long as you need it, so it's important to have a solid plan in place. This involves careful planning and possibly consulting with a financial advisor. Your risk tolerance is likely lower than ever before, and that's perfectly fine. It's natural to want to protect what you've accumulated over the years. You don't want to take on unnecessary risks with your hard-earned savings. Avoiding high-risk investments is a prudent approach at this stage of life. This means your portfolio should be heavily weighted towards those lower-risk investments like bonds and fixed-income securities. These provide a more stable and predictable return. But here's the thing, you still need some growth in your portfolio, even in retirement. A completely conservative approach might not be enough to keep up with inflation. Remember inflation? It doesn't just magically disappear when you retire. In fact, it can significantly impact your purchasing power over time. You still need your money to keep up with the rising cost of living. This means planning for future expenses and ensuring your investments can grow to meet those needs. So how do you balance preservation and growth in retirement? It's a delicate balance, but it's achievable with the right strategy. Well, a good strategy is to create a bucket system. This approach helps you manage your money based on different time horizons and financial needs. Divide your money into different buckets based on your time horizon. Each bucket serves a specific purpose and has its own investment strategy. For example, you might have a short-term bucket for your living expenses for the next few years. This ensures you have readily accessible funds for immediate needs. This bucket would be invested in very low-risk investments like high-yield savings accounts and money market funds. These options provide liquidity and safety. Then you might have a mid-term bucket for your expenses in 5 to 10 years. This allows for a bit more growth while still maintaining a relatively low risk. This bucket might be invested in a mix of bonds and some dividend-paying stocks. These investments offer a balance of income and growth potential. Finally, you would have a long-term bucket for your expenses beyond 10 years. This bucket can be invested in assets with higher growth potential, as you have more time to ride out market fluctuations. Chapter 5. Adjusting investments over time. Staying flexible with your financial journey. Now here's the thing about investing. It's not a set it and forget it kind of deal. Your life is constantly changing, and your investment strategy needs to change right along with it. Think about it like this. Your risk tolerance, your financial goals, your time horizon. These are all moving targets. What made sense for you in your 20s might not make sense in your 40s, and that's okay. The key is to be adaptable and to adjust your investment strategy as needed. One of the biggest mistakes people make is being too rigid with their investments. They create a plan and then they're too scared to deviate from it, even when it's clear that they need to make a change. Don't be afraid to reevaluate your investments regularly and make adjustments as needed. For example, let's say you're in your 30s and you're heavily invested in growth stocks. Suddenly, you and your partner decide to buy your first home. This is a major life change that could warrant a shift in your investment strategy. You might want to consider reallocating some of your portfolio to something more conservative like bonds to balance out the risk of your new mortgage. The point is, life is unpredictable, and your investments should reflect that. There you have it, a crash course on investing smart based on your age, risk tolerance, and time frame. Remember, investing doesn't have to be complicated. It's all about making your money work harder for you so you can achieve your financial goals and live the life you want. Thanks for watching, and remember to like, subscribe, and hit that notification bell so you don't miss out on more videos like this one. See you in the next one.